We are covering these 8 top big cap stocks with large percentage moves today. While watching bullish price actions, let us inform you. Our review on RGC Regencell Bioscience Holdings Ltd is having a breakout year, with its stock soaring over 260%, a move that's definitely turning heads. Anytime a biotech stock sees this kind of massive gain, you have to ask, what's driving the momentum and is it sustainable? Are retail traders jumping in for the ride, or are they cautiously watching from the sidelines, waiting to see if this rally has real legs? Regencell is playing in a fascinating space. Unlike most biotech firms that focus on synthetic pharmaceuticals, the company is all in on traditional Chinese medicine, TCM, to tackle neurocognitive disorders like ADHD and autism. They've developed 3 liquid-based, standardized formulas designed for different severity levels of these conditions, which sets them apart from the conventional Western approach. There's a growing market for alternative treatments in these areas, as many parents and caregivers are looking for options beyond standard pharmaceutical drugs, which often come with significant side effects. That's where Regencell's value proposition gets interesting. It's offering a different path for managing ADHD and autism, and investors are clearly paying attention. So what's fueling this massive stock run? A 260% jump doesn't happen in a vacuum. It could be due to increasing investor confidence in the company's commercialization strategy, signs of regulatory progress, or even early market adoption of their TCM-based treatments. It's also possible that speculative momentum is playing a role. Hot stocks with unique stories often attract traders looking for the next big thing, and once momentum builds, it can fuel even bigger moves. For investors, the key question is whether Regencell can deliver on the promise behind the hype. If they can secure widespread adoption of their treatments and navigate the regulatory landscape effectively, they could carve out a lucrative niche in the biotech space. But with any stock that sees such a dramatic rise in a short period, volatility is part of the game. A high-risk, high-reward scenario like this one demands a careful approach. Either you're in early on something that could be a long-term disruptor, or you're riding a wave that could correct just as quickly as it surged. At this stage, Regencell is clearly a stock to watch. Whether retail traders are actively piling in or just observing from the sidelines, one thing's for sure. This company is now on the radar, and whatever happens next could have big implications for its future, and for investors looking for biotech opportunities beyond the traditional pharmaceutical model. Our review on TNXP. Tonix Pharmaceuticals Holding Corporation just got a big vote of confidence from Noble Capital Markets, with analyst Robert Lebeler reiterating an outperform rating and sticking to a $70 price target. That's a bold stance, especially considering Tonix is currently a small-cap biotech navigating the tricky world of drug development. But it does raise the question, what's the bull case here? And does the stock have the runway to hit that kind of valuation? Tonix has a pretty broad pipeline, but its main focus is on central nervous system, CNS disorders, which is a space with huge market potential. Its lead candidate, TNX-102SL, is in the works for fibromyalgia, an area that has seen relatively limited treatment innovation. There's also TNX-1300, a biologic designed to treat cocaine intoxication, which could be an interesting niche opportunity if it gains regulatory approval. Beyond that, the company is working on immunology therapies for autoimmune diseases and transplant rejection, as well as vaccines targeting infectious diseases. It's a diversified approach, but with any early-stage biotech, execution is everything. Now, let's talk about that $70 price target. Given that Tonix is currently trading at a fraction of that, this projection suggests massive upside if the company can deliver. That means advancing its pipeline, securing regulatory approvals, and proving commercial viability. Of course, biotech investing is never a straight path, and there are risks, including clinical trial setbacks and funding needs. The market's reaction to this rating will be key. If investors start buying into the long-term vision, we could see momentum build. But if skepticism lingers, especially around the feasibility of hitting the target, the stock might stay volatile. Either way, Tonix is now on the radar, and for investors looking at high-risk, high-reward biotech plays, it's one to keep an eye on. Our review on NAK. Northern Dynasty Minerals Ltd has been in the spotlight for years, thanks to its massive Pebble project in southwest Alaska. This is one of the world's largest undeveloped copper-gold molybdenum deposits, and if it ever gets the green light, it could be a game-changer, not just for the company, but for global supply chains in these critical metals. But that's a big if, and investors know it. The stock tends to move on regulatory and legal updates, and right now, it's in a bit of a holding pattern. The Pebble project has faced significant pushback from environmental groups, local communities, and even the U.S. government. The Army Corps of Engineers initially denied its key permit back in 2020, but Northern Dynasty has been fighting back, arguing that the project can be developed responsibly. If they manage to overturn that decision, or even make progress on a scaled-down version of a mine, shares could react in a big way. For investors, the risk-reward profile here is clear. On one hand, if Northern Dynasty can navigate the regulatory maze and get approvals, the value of its asset is enormous, especially as demand for copper skyrockets with the push toward electrification. On the other hand, if legal battles keep dragging on or if the permit remains blocked, the company could struggle to keep investors engaged. It's a classic case of high risk, high reward. Right now, traders and long-term speculators are keeping an eye on any updates out of Washington or Alaska. If the political winds shift, this could be a big comeback story. If not, it's a waiting game. Either way, it's one of the more intriguing plays in the mining sector. Our review on HUHU. HUHUTECH International Group Incorporated might not be a household name, but it plays a critical behind-the-scenes role in high-tech manufacturing. The company specializes in factory management and monitoring systems, catering to semiconductor, LED, and microelectronics manufacturers, as well as select pharmaceutical and food production facilities. Its core strength lies in high-purity gas and chemical conveyor systems, essential for industries where even the smallest contamination can be a major issue. With the ongoing global semiconductor boom, demand for advanced factory management solutions is growing. As chip makers continue expanding production and investing in next-generation facilities, companies like HUHUTECH could see increased demand for their specialized systems. However, the semiconductor industry is cyclical, and any slowdown in manufacturing could impact growth. The company's primary market remains domestic in Japan, but potential expansion into other regions or strategic partnerships with major industry players could be key catalysts for future growth. For investors, HUHUTECH is one of those under-the-radar companies that thrives on industry trends rather than direct consumer demand. If semiconductor and high-tech manufacturing investment continues to rise, HUHUTECH could be in a strong position to benefit. Our review on CRVO. CervoMed Inc. is pushing forward in the biotech world with its lead drug candidate, neflamapimod, an oral treatment aimed at tackling neurodegenerative diseases like dementia with Lewy bodies, DLB, and early Alzheimer's. What makes neflamapimod stand out is that it's not just about managing symptoms. It's designed to address synaptic dysfunction, a key factor in disease progression. Essentially, it's going after the root of the problem, not just trying to patch things up. Now, the latest extension study data for dementia with Lewy bodies has sparked some real excitement. Early findings suggest the drug might actually improve cognitive function in patients, which would be a huge win for a disease that currently has very limited treatment options. But, as with any promising biotech development, there are caveats. Clinical trials are a long and complex process, and while this data is encouraging, regulators will need to see more, particularly long-term safety and efficacy results, before moving forward. For investors, this kind of news can be a double-edged sword. On one hand, if neflamapimod continues to show positive results, CervoMed could be looking at a major breakthrough in a high-need area, which would be a game-changer for both the company and patients. On the other hand, the biotech space is notoriously high risk, and any setbacks in trials or regulatory hurdles could shift sentiment fast. Still, For those willing to ride the volatility, this is definitely a story worth keeping an eye on. Our review on BGM. BGM Group Ltd, formerly Chilean International Holding Group Ltd, is making moves in the pharmaceutical and agricultural sectors with a diverse product lineup ranging from licorice and oxytetracycline to traditional Chinese medicine derivatives, heparin, sausage casings, and fertilizers. Operating mainly in the domestic market, the company has built its reputation under the Chilean Shan brand, and now it's making a significant leap with its latest acquisition. The company just announced it's acquiring HUHUTECH in a $95 million deal, which is set to shake up its ownership structure. Once the dust settles, HUHUTECH shareholders will hold a sizable 32.8% stake in BGM. That's a big shift, and it signals that this isn't just a small bolt-on acquisition. This is BGM expanding its reach in a meaningful way. For investors, the key question is, what does this mean for BGM's long-term growth? Acquisitions can be a major catalyst for value creation, but they also come with risks, especially when integrating new operations and managing the financial impact. If BGM can effectively leverage HUHUTECH's assets and capabilities, this could boost its market position and revenue streams. But as with any deal, execution will be critical. Investors will want to watch how BGM handles the transition and whether this move translates into real business gains. Our review on PHH. PHUHU Biological Technology is a holding company based in the Cayman Islands with a pretty unique setup. While the company itself doesn't have operations directly, it's got a trio of operating subsidiaries in China, which is where the real action happens. These include Xinjiang, PHUHU Jiangsu, and PHUHU Shanghai, all of which are based in key regions of China and focused on different aspects of the biological tech space. For investors, the key thing to note here is the structure. Because PHUHU doesn't directly run operations, but instead relies on these subsidiaries, the growth and financial health of those subsidiaries are crucial to the company's overall performance. If these subsidiaries are able to ramp up operations, make solid gains in their respective markets, and expand their reach, it could lead to a rise in PHUHU's stock performance. But of course, like with any holding company, there's a bit of a wait-and-see game as you look at how well the subsidiaries are doing in China's competitive market. Our review on ZYBT. Zhengye Biotechnology Holdings Ltd is diving deep into the veterinary vaccine market, particularly focusing on livestock. They've built up a strong portfolio of around 44 different vaccines, covering a wide range of animals from swine and cattle to poultry and even dogs. Whether it's monovalent vaccines or more complex polyvalent and combined vaccines, their goal is to protect livestock from various diseases, and that's a huge deal in the agricultural world. What's really worth noting for investors is how Zhengye is expanding its footprint both domestically and internationally. The demand for veterinary vaccines is on the rise globally, thanks to concerns around livestock health and disease outbreaks. With Zhengye's established portfolio and focus on this growing market, they're in a solid position to capitalize on these trends. However, their growth will come down to whether they can maintain the high quality of their products and successfully push their vaccines into new markets. If they continue to expand and their products gain more traction, it could be a good signal for their stock performance going forward. Please subscribe, give the video a like, and watch more from our playlist. Thanks.